last section or part on deferred tax. We are looking at part 3.1. We are talking about the impact of assessed losses on deferred tax, and lastly the precedent disclosures. These sections are very critical. Assessed loss are highly tested, but they are also a little bit complex. Quite a lot of our questions, or in practice when you are preparing or as an auditor auditing, you mostly have presentation and disclosures to audit or to prepare, which are very much deliverables or information that should be seen, and any non-compliance would definitely not reflect well on the owner. Let's talk specifically on assessed losses. So assessed losses arises when an entity makes assessed losses from normal tax or tax credits. In this case, we are talking about you have calculated the entity has been making loss or trading losses, and we are not making enough income to cover our deductible expenses. So a deferred tax asset shall be recognized for the carrying forward of unused tax losses and unused tax credits to the extent that it is probable that the future profit will be available. This was very connected with paragraph 24 and specifically dealt with under paragraph 34. So indicators that shows future taxable profits may not be available are, now let's go back and say we made losses during a year, and the first question that we have to ask ourselves, we say this is the accounting loss. We deduct and put all the income to come up with the tax loss. When you come up with that tax loss, we cannot calculate current tax. I'm sure that we dealt with that under current tax. We can't calculate current loss on that. But the taxman allows us to carry forward that loss and deduct it in future on future taxable income. So you can only recognize a deferred tax asset. In other words, you are saying this will reduce my future tax, current tax. So by reducing a future current tax, that's a possible asset today. It has happened now, that's why we should recognize it now. Only when you have got something to deduct. In Zimbabwe, tax losses can be carried forward for 6 years on a rolling basis. So if you cannot deduct your losses for 6 years, it means that they lapse. You forfeit them, you can't deduct them in the year 7. So it can only be an asset to an extent that there will be future profits that you can deduct your current losses. So what are the indicators that shows future tax profits? Recent operation, indicators that show future taxable profits may not be available. Recent operational losses. So if you're continuing to make losses, history of unused or expired tax loss or credits, or management expectations, where management just expect that it's not going to be easy. This is a very critical judgment area, and appropriate assessment should be made to estimate availability of future taxable profits. Generally, you would see that when we do our disclosures, you might want to disclose given judgment on whether you have made a judgment of saying there will be taxable profits or there won't be taxable profits. You need to assess availability of future taxable income. An entity can do that criteria. The probability of taxable income comes in whether there is sufficient taxable temporal differences, whether it is probable that the entity will have taxable profits, unused tax losses result from identifiable causes which are likely to recur or unlikely to recur. There could be also very good tax planning opportunities that could reverse any losses, and to the extent that it is not probable that future taxable profit will be available against which the deferred tax is not recognized. So we need to assess what could be done to bring through taxable profits. If you can't, you cannot recognize. There is need of reassessment of the deferred tax asset at an annual basis. So at the end of the reporting date, an entity reassesses the recognized deferred tax asset. The entity recognizes a previously unrecognized deferred tax asset to the extent that it becomes probable that future taxable profits will allow the deferred tax asset to be recovered. Implications of reassessment of deferred tax assets. The remeasurement and adjustment of the deferred tax asset does not result in prior year restatements. It is a change in estimate, accounting estimate, and should be accounted prospectively. So that is also very important, and deferred tax assets and recognized deferred tax assets should be disclosed in the financial statements. So there is example 16 to 18 that deals with assessed losses, and from example 16, 17, 18, we have actually shown gradually the ways in which you can apply your assessed losses for current and deferred tax. But I want to bring you to question 2, Lions Limited, at the end, which is what we call self-assessment questions, at the end of the chapter. So question 2 has been designed to inculcate or to make it possible for you to understand. So we give you accounting profit for the year of 450, and in that account profit there's dividends of 10,000 that are not taxable, and the penalty, as well as prepaid expenses and unused tax loss of 550 from the previous year. And ZIMRA also reflects an assessment tax loss of 550. So assessed loss is what you do, what an entity does as self-assessment, but assessed tax loss by ZIMRA is what ZIMRA agrees to. Lions also had a machinery, and which ZIMRA gives 25%. So this example is comprehensive, that it is similar to probably example 21, and it adds in assessed losses. Then it has got about 3 scenarios. Under the 3 scenarios, scenario 1 says the question wants you to prepare the income tax note and deferred tax note for the year ended 31 December 2012. But under scenario 1, you have to assume that future taxable profits are probable for both years ending 31 December 2011 and 31 December 2012, as the budget of 2012 reflects new contracts that will increase. So in that case, on the calculation of deferred tax, it's very important to have 2 distinct sections on calculating deferred tax. One for the normal assets and liabilities, and the other one for assessed losses. In each and every year, so if you are on calculation 2 or C2 scenario 1, you need to show the 2 years so that you can find our movement in temporary differences. When you look at 2011, first of all, one has to calculate deferred tax for all other assets and liabilities except assessed losses. So you've got your prepaid expenses, 60,000, temporary difference 0, you calculate that, and you finish and come up with your temporary differences. Right? Since it was 1, there was only 60,000. Then you only then put assessed loss up. Assessed loss is not an accounting concept, so it doesn't have a carrying amount, but it is a tax concept, so there is a there's a tax base. Now for you to deduct or to put a temporary difference, when you say 0 carrying amount minus 550, for you then need to consider the principles we've talked about, where we said, do we have future taxable income? Yes, because of future taxable income. That's why under scenario 1, the temporary differences at the beginning of the year, since the scenario said there was expectation of future taxable income both in 2011 and in 2012. That's why under temporary difference we could put 550. And then the temporary differences and the deferred tax is calculated. In 2012, we also now had a machinery. So we calculate just normal, always start with that one. Then the assessed losses are also done only at the end, after I've done all other temporary differences. Assessed loss, we calculated, we did our calculation. So if you go to calculation 1, where you calculated our profit for year, so profit for the year, dividends received, penalty movement, then we deducted assessed loss at the bottom. So at the end of year 1, we now have got 50,000, which is end of 2012. Now, is that 50,000 deductible? And the scenario said, yes, there will be future taxable profits. That's why we can put the whole 50 under temporary differences. Now, when you then do your movement temporary differences, do movement temporary difference for all other assets and liabilities except assessed losses. Then do movement for temporary difference for assessed losses separately. Because these are presented separately, while these others are aggregated, assessed loss has to be shown separately. So if you take for scenario 1 back to the tax expense note on page on question 2 at the beginning of the suggested solution, the income tax expense shows current tax. There is no current tax because there is an assessed loss in 2012 at the end of 2012. But there is movement in deferred tax. The movement in deferred tax, the first one, is from other temporary differences, which is the 60,000 prepaid and the PPE, 60 minus 15, which is 45, which gives us 11,588. So we see that there is a decrease in deferred tax because we had a higher temporary difference. Now it's less, which means deferred tax decreases. If deferred tax decreases, tax expense increases. Current tax increases. Okay, so the deferred tax liability decreased there. So debit deferred tax, credit tax expense, that's why it's a negative. But our unutilized tax losses also decreased. So the deferred tax asset was higher. It was 141,625. Now it's less. It's very important that with the movement of 128,750, in other words, we are reducing our tax expense, credit tax expense, we're debit tax expense, credit deferred tax asset. In that case, that's why we have there under scenario 1. So what is very critical on calculating deferred tax is to be able to calculate all other temporary differences first and finalize them, and only put assessed loss separately, and you put them and assess the probability of future taxable profits per each particular year. So if you look at example scenario 2, assume the taxable profits were probable in 2011 but were not probable in 2012. You can see that the scenario 2, because they are probable future taxable profits, you can put the 5 differences. But when you come to 2012, because they are not probable, we can only limit our 50,000 to the available temporary difference of 15. If you look at scenario 3, future taxable profits were not probable at 31 December 2011, but are probable at the end of 2012. If you look at that, scenario 3 shows that when we had our 55 at the beginning of in 2011, we did not put the whole 55 as part of temporary differences. We only put the extent of the other temporary differences. However, at the end of the year, we put the whole 50,000. The reason why we first have to do all other temporary differences is because we have to finalize them, and they form the basis of limiting of what we could put as temporary differences as far as assessed losses are concerned. Please take time and spend some time dealing or playing with this example until you understand thoroughly and comprehensively the mechanics and disclosure elements of assessed losses. They do affect our tax reconciliation, as you would see there. An assessed loss not recognized and unrecognized assessed losses, they do affect our tax reconciliation as well. And this example is comprehensive enough and will sort out anything to do with assessed loss henceforth. So please bring through any questions that you may have as far as assessed loss are concerned. I quickly would want to take you to present disclosure. Through the process that we've been going through, you've been seeing a lot of disclosures where you were required to calculate the tax expense or prepare the tax expense note and the deferred tax liability. So I would quickly deal with presentation. So as far as the profit and loss is concerned, there is the presentation. The tax expense is presented below the profit before tax. All other income and expenses are presented above. However, items like share of profit and associate are shown net of tax, and a lot of times these then become permanent differences because they don't contribute into the tax expense. In the other comprehensive income, as shown below, you put your income gross, then you show the tax expense, or you could show your income net of tax. Where you show your income net of tax, you then have to show a separate tax expense disclosure for the other comprehensive income. Now, when you come to the disclosures, the accounting policy and explanatory questions. So the accounting policy should talk to the current tax, how the current tax is recognized and how it's measured. And I'm sure most of the information or the focus is on measurement of current tax. Deferred tax, a lot is on the recognition and measurement of deferred tax. We also identify that deferred tax and current tax may have so much judgment and estimation that happens, especially when there's assessed loss, especially when we are talking about capital gains tax or timing of reversal. So those significant judgment and estimates should be disclosed as the basis in which the deferred tax calculations or the tax rates have been arrived at. And the user needs to know what management or the preparer has gone through to arrive at that. We then also need to look at the tax expense reconciliation. So we've learned to see the structure of the tax expense, okay, which shows normal tax, current and deferred, capital gains, current and deferred, and so. But we now need to say where the tax expense is different from the expected. What is expected? If I take my profit for tax, I multiply by a tax rate, I normally would expect that should be the tax expense. But when it's different, it's appropriate to show why it's different. And that is done under the tax expense reconciliation. The tax expense reconciliation is part of the tax expense note. So there is a requirement under paragraph 81C that says there should be an explanation of the relationship between the tax expense income and the accounting profit. And this should be presented in either numerical reconciliation between the tax expense or numerical average effective tax reconciliation. So you can also show in amount or in rate. And this is easily presented. So this is where the numerical reconciliation, where you're saying this is my profit before tax, accounting profit. So if I take my accounting profit and apply the standard rate, this is an example from the standard, just to illustrate. So in this case, 35%. In our case in Zimbabwe, is 25.75%. So in the case of 35% for this year, for the current year, which is 40%, 8740 times 40%, you get 3050. What happened? What was adjusted to this profit such that it does not become, so that the tax expense is not exactly 3059? It's because mostly of the permanent differences. There were charitable donations of 122 that was added back before we calculated. And also there's a reduction in opening deferred tax assets. In other words, there's a change in tax rates, deferred tax assets, which is actually impacted on our tax expense. Those are reconciled so that we show our tax expense. You can also show it in red. So you can agree that if I take the this amount, put it over the profit before tax, that will give me the same percentage. So for each and every element, that's the reconciling item over the profit before tax. So you're saying X over profit before tax. You then can get an effective percentage. That effective percentage gives you the net average tax rate, which is almost like saying your tax expense over profit before tax. So to come to this, you are saying the tax expense over the profit before tax. And at any time, if you want to evaluate the accuracy where this has been presented, a lot in practice, many disclosures are in percentage, mostly because they won't be properly balancing. If you show amounts, you have to really balance or reference to the tax expense. But using this, people use it because it hides away incorrect applications. But the simple test is to take your tax expense, this rate, and multiply by the profit for tax to see whether it is equal to the tax expense. Deferred tax note needs to be disclosed as well. But the deferred tax note disclosure is very simple. So you include the analysis of temporary differences, then you also include the reconciliation of the opening and closing. The analysis of temporary differences is a mirror of the deferred tax calculation. So opening balance of the deferred tax, okay, then you show the temporary difference and analysis, which is you say your plant, your investment property as an example, your prepayment asset, revenues in advance, you show your closing balance. Then you can also show your reconciliation, as we learned earlier, that deferred tax is recognized in different statements. And in that case, you are saying your opening balance, then you show us how much of the movement that went through profit and loss, that went through OCI, that went through equity and goodwill, and that ties out with the closing balance. This is simply the requirement. The section on disclosure is very important to understand how to create disclosures and to calculate. Any requirement to prepare disclosures almost test everything that we have learned, and most of the examinations will be on disclosures and preparation of specific notes. Lastly, set off. Paragraph 74 of IAS 12 connects very well with paragraph 32 of IAS 1 that refers to set off. The IAS 1 refers that set off is only allowed by a specific standard. Therefore, paragraph 74 says current and deferred tax assets and liabilities should not be offset, and especially if they're coming from different entities, unless there's a set-off agreement with ZIMRA and the respective entities or entity, and that's normally not the case. So current assets should be shown, current tax assets and current tax liabilities should be shown separately. Deferred tax assets and deferred tax liabilities should be shown separately. Where still, if it's in consolidated and coming from different entities. Ladies and gentlemen, this is the end of the basic concepts of deferred tax for now. You need to watch out on the next sections that will cover specific or complex sections of deferred tax. So we'll go into financial instruments, we'll go into manner of recovery for investment property, for PPE and share-based payments, intra-group transactions, and also we hope and would like to work with you example 2 or question 2 that illustrates assessed losses. I hope you have learned something. I hope we've given you some sort of understanding, and I thank you.